Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research or consult a licensed professional before investing. Most people believe that becoming a good investor requires complexity, stock picking, constant analysis, timing the market, studying charts, and staying glued to financial news. Yet, ironically, decade after decade, most professional investors fail to beat the market. And that's where one of the simplest and most powerful strategies in the world stands out: the lazy portfolio. A portfolio so simple that you can manage it in less than an hour per year. Yet over the long term, it beats the majority of actively managed funds. This strategy is based on the philosophy of the Bogleheads, followers of John Bogle, the founder of Vanguard and the inventor of the index fund. Bogle's message was brutally simple: don't look for the needle in the haystack. Just buy the whole haystack. In other words, stop trying to pick winners and losers. Instead, own the entire market. Keep your costs low and stay invested for decades. The lazy portfolio brings this philosophy to life with an elegant, minimalistic design, an 80-20 allocation. That means 80% in stocks, 20% in bonds. No complicated formulas. No constant changes. No reacting to whether the economy is good or bad. It's a long-term strategy that is built on discipline, diversification, and patience. So why 80-20? Because history shows that stocks grow wealth and bonds stabilize it. The 80% invested in stocks, usually through broad ETFs like an S&P 500 fund or a global index, gives you long-term growth, capturing the power of capitalism, innovation, and compounding. Meanwhile, the 20% invested in bonds acts like shock absorbers. When the market crashes, the bond portion cushions your fall. It gives your portfolio stability, reduces stress, and most importantly, gives you something to rebalance with. And that takes us to the heart of the lazy portfolio: rebalancing. Now, let's visualize how this works in real life. Imagine two investors, Maria and Daniel. Maria uses the lazy portfolio. She invests steadily every month, ignores the news, and rebalances once per year. Daniel tries to time the market. He buys tech stocks when they're hot, sells when he gets scared, and jumps between trends. At the end of 20 years, the data is overwhelmingly clear. Maria's simple, boring strategy wins. Not because she's smarter, but because she removes the biggest risk in investing herself. That's the secret of the lazy portfolio. It's not lazy because it ignores the market. It's lazy because it removes unnecessary decisions. No constant management, no emotional trading, no chasing performance. And when you remove decisions, you remove mistakes. Studies from Vanguard, Morningstar, and academic researchers all show the same conclusion. The average investor underperforms the market because they buy high, sell low, and react emotionally. The lazy portfolio protects you from yourself. The beauty of the strategy is that it works with ETFs listed anywhere: European ETFs, US ETFs, global ETFs. The key is choosing low-cost funds with broad diversification. For stocks, many investors choose something like a global ETF or a simple S&P 500 tracker. For bonds, they pick a high-quality government or aggregate bond ETF. And that's it. 2 ETFs, 1 yearly check-in, and decades of compounding. But the magic of this strategy isn't just mathematical, it's psychological. The lazy portfolio gives you clarity. It gives you a plan. It gives you rules to follow when markets panic and headlines scream disaster. It turns investing from a daily battle into a long-term journey. And while everyone else jumps between trends, cryptocurrencies, meme stocks, hot sectors, timing the Fed, you simply stay invested and let time do the heavy lifting. Successful investing isn't about predicting the future. It's about having a system that works in any future. And the lazy portfolio does exactly that. It has survived recessions, bubbles, wars, inflation, crashes, recoveries, and through it all, it has consistently delivered strong returns with low stress. So, if you're looking for a simple, effective, long-term strategy, the lazy portfolio may be exactly what you need. 2 ETFs, 1 allocation, 1 yearly rebalance, and a lifetime of financial growth built on discipline instead of guesswork. Thanks for watching Money Mindset. If you enjoyed this breakdown of the lazy portfolio and want more ETF investing strategies, make sure to like, subscribe, and turn on notifications. Tell us in the comments, what allocation do you use in your portfolio?